Welcome to this explainer, everyone. Today we are absolutely decoding the complex mathematics and the fascinating behavioral psychology behind true wealth building. And we're getting all of this directly from our curated source material. Look, we're going to break down the exact hidden mechanisms that separate the people who are constantly losing sleep over money from the people who achieve total, untouchable financial independence. And spoiler alert for you right up front, it has a lot less to do with your actual salary than you probably think. We're totally moving beyond that generic, surface-level financial advice you hear everywhere, and we're going to give you a really deep, comprehensive look at how money actually operates over the course of a lifetime. It's like a giant puzzle, and we're putting the pieces together today. Okay, let's dive right into our roadmap for today. First, we'll cover the psychology of wealth. Second, real estate versus stocks. Third, the Social Security faucet. And fourth, defining true financial independence. Section 1, the psychology of wealth. So the overarching theme pouring out of our sources is incredibly clear. Building wealth starts entirely in your mind, not in your wallet. To really grasp this, I want you to imagine two apartments located in the exact same neighborhood. As our source material beautifully illustrates, the first apartment belongs to someone bringing in $95,000 a year. You walk in, and there's a massive 75-inch TV on the wall, a pristine $4,000 leather sectional, brand new appliances literally still sitting in their cardboard boxes, and closets completely overflowing with clothes that still have the price tags hanging off them. Yet, despite all this stuff, this person checks their bank account with a literal knot in their stomach. They are sweating because they are exactly two missed paychecks away from a total financial meltdown. Now, let's walk next door to the second apartment. This person earns $52,000 a year, which is almost half as much as their neighbor. They have a totally modest couch, a normal-sized television, and here's the kicker. Their spare bedroom is actually used as a bedroom rather than a glorified storage unit. But this person, they check their bank account with absolute calm and confidence. They're sitting on a rock-solid 18-month emergency fund, and they seamlessly invest 20% of every single paycheck. So think about that. The person earning almost half the income has 10 times the financial security. This stark contrast absolutely proves that income alone does not create security. It's all about the hidden, psychological relationship between the stuff we accumulate and the money we keep. Now, you might be wondering, what is the behavioral psychology behind why that high earner is perpetually broke? Well, it is fascinating, and it's called Parkinson's Law. You might actually know this concept from project management or from being a student. It's the classic idea that if you have a full week to finish a project, it miraculously takes exactly a week. But if your boss says you have 1 hour, boom, you get it done in an hour. The work simply expands to consume whatever time is available. Well, guess what? It is the exact same mechanism with our money. Our spending will automatically, unconsciously expand to consume all available income unless we actively step in and restrict it. Whether you're making $100 a week or $100,000 a year, your lifestyle expenses will continually creep upward to eat every last cent of it. This is the hidden trap, the exact reason why incredibly high earners constantly go broke. Telling yourself that you'll just save whatever happens to be left at the end of the month is a mathematical impossibility. Because under Parkinson's Law, there will literally never be anything left. Okay, so how do we actually defeat Parkinson's Law in the real world? Our sources make a massive point here. You absolutely cannot rely on willpower. Willpower is totally fragile. It depletes throughout the day, especially when you're tired, stressed out, or emotional. But you know what doesn't deplete? Your environment. The real trick here is to reverse your bad money habits by building structural, rock-solid systems that make good financial decisions completely and utterly automatic. First off, you have to treat saving like it's a non-negotiable monthly bill. You pay yourself first, routing your money directly into your investment accounts before you even log in and see it in your checking account. Out of sight, out of mind. Second, you have to nuke the environmental triggers. Go ahead and delete those shopping apps off your phone right now and scrub your saved credit card numbers from all your favorite online retailers. Make it difficult to spend. Finally, enforce a strict 24-hour waiting period for absolutely any non-essential purchase. You would be amazed, literally shocked, at how many of those burning purchase desires just completely evaporate into thin air when they're forced to survive a 24-hour waiting period. So what you must take away from this is clear. Stop trusting your future wealth to your daily willpower. You have to design a routine where you literally cannot make impulsive choices. Once you get those automatic systems locked in and running smoothly in the background, you begin marching toward a very specific, incredibly important mathematical threshold: $20,000. Our source material really highlights this exact figure as the very first major invisible barrier of wealth building. Why? Because the moment you hit this specific number in your investment accounts, the underlying math of compounding finally wakes up and starts doing the heavy lifting for you. To really put this into perspective, think of it exactly like pushing a massively heavy boulder up a really steep hill. Look, saving your first few $1,000s is an absolute grind. It's tough. It is 100% your own blood, sweat, and labor moving that rock inch by inch. But hitting that $20,000 mark, that is the peak of the hill. If you have $20,000 invested and it earns, say, a historical 8% annual return, that translates to an extra $1,600 magically appearing in your account over the course of a year. That is a substantial amount of money that you simply did not work for. It showed up for no other reason than because your existing money went out and worked on your behalf. At this point, gravity completely takes over. And honestly, more importantly than the math, achieving this milestone fundamentally rewires your brain. You actually start evaluating your everyday purchases, not just by their basic price tag, but by their long-term opportunity cost, which is an incredibly powerful concept we are going to explore deeply in just a few moments. Section 2, real estate versus stocks. So we know we need to be compounding our money, but where exactly should that money be sitting? Let's wade into the great endless debate of investing, real estate versus stocks. We're going to compare the two absolute most popular paths for accumulating massive wealth. Our source material provides this brilliant standardized comparison to really make this concrete. Let's look at two hypothetical guys, Jake and Marcus. They were the exact same age, they live in the exact same city, and they both happen to have exactly $50,000 in cash ready to invest. Jake takes his $50,000 and uses it as a 20% down payment on a solid $250,000 rental property. By doing this, he is using 5-to-1 leverage. That means he is controlling a massive $250,000 asset using mostly the bank's money. It's powerful. He gets monthly cash flow, he gets sweet tax write-offs through depreciation, and he gets a really great conversational flex for dinner parties. But on the flip side, he also gets incredibly stressful 10 p.m. weekend repair calls because a tenant's toilet backed up. He deals with an average of 1 month of empty vacancy a year, and he's bleeding 1% to 2% in annual maintenance costs. Marcus, on the exact other hand, takes his $50,000 and drops it straight into a broad index fund, and then sets up an automatic $300 a month contribution. He spends literally 0 hours a week managing it. He enjoys total instantaneous liquidity if he needs his cash. But his investment is entirely abstract, just numbers on a screen, and he has to completely stomach brutal market volatility. We're talking about riding out terrifying drops like that 34% plunge we all saw in a single month back in March 2020. The real takeaway here is that neither strategy is inherently wrong, but they both require drastically, completely different lifestyle and psychological commitments from you. Now, when we fast forward and run the real, unvarnished numbers after a 10-year hold, the results are actually pretty shocking. If we meticulously account for all of Jake's real-world costs, we're talking the mortgage interest, the property taxes, the insurance, the endless repairs, the tenant vacancy, and the big capital expenditures like a new roof, his total equity ends up sitting roughly between $170,000 and $184,000. Meanwhile, let's check in on Marcus. With his boring, consistent $300 monthly contributions and historical average market returns, he has a completely passive portfolio sitting right between $165,000 and $180,000. Yes, Jake is technically slightly ahead, and that's entirely due to the sheer mathematical power of that 5-to-1 bank leverage. However, Marcus achieved almost the exact same total net worth while spending 0 weekends doing house repairs, handling absolutely 0 tenant disputes, and taking on 0 anxiety-inducing debt. It's a massive difference in quality of life. So the ultimate defining difference between these two paths, according to our sources, ultimately boils down to one word: scalability. Think about it. If Marcus decides he wants to aggressively scale up his wealth, he literally just opens an app, clicks a few buttons, and increases his automatic stock contribution by $200 a month. That small, painless bump multiplies effortlessly over time through the magic of compounding. But for Jake to scale his real estate wealth, he can't just casually buy $200 more of a house. It doesn't work that way. To scale, he has to aggressively save up tens of thousands of dollars all over again for another down payment, undergo the stress of taking on another massive 30-year mortgage, and literally double his weekend workload by actively managing a second property. Again, one path is not inherently better than the other, but you absolutely have to know which game you are actually signing up to play before you start. Section 3, the Social Security Faucet. All right, let's fast forward a bit to the harvest phase of wealth. We're shifting our focus now to untangling the incredibly complex, often misunderstood math behind Social Security timing. Our source material uses a truly phenomenal metaphor to explain this, and I love it. I want you to think of Social Security exactly like a highly pressurized water faucet that's attached to a pipe in your wall. Every single year you wait to turn that faucet on, the water pressure builds up. If you manage to hold out and wait until age 70 to turn it on, you get the absolute maximum pressure. The water just flows faster, harder, and heavier. But here is the massive catch. That faucet belongs to you. And if you wait way too long before finally turning it on, some of that precious water just sits idle in the pipe and evaporates, completely undrank. And guess what? Nobody is going to refund you for the water pressure you never used. So the ultimate million-dollar question we all face is, when exactly do you open the faucet? Let's walk through the standard break-even math together, using a hypothetical guy from our sources that we'll call Professor Pat. Let's say Pat earned a very solid $90,000 in his final working year. When he approaches retirement, he basically has three choices in front of him. Option 1, he can file as early as legally possible at age 62 and start collecting a modest $2,238 a month. Option 2, he can wait until his designated full retirement age, which is around 67, to get a bumped up $3,198 a month. Or, option 3, he can tough it out and delay all the way to age 70 for that absolute maximum faucet pressure, pulling in nearly $4,000 a month. Now, obviously, there is a massive gap between getting $2,200 and nearly $4,000. And this gap is exactly why the traditional break-even analysis exists. It simply asks a math question. At what specific age does waiting around for those much bigger monthly checks finally overtake the multi-year head start of taking the smaller checks early? This standard textbook analysis almost always pushes people to wait, usually suggesting the magical crossover point happens somewhere in your early 80s. But, as we're about to see, there is a massive, glaring flaw in treating your life like a simple math equation on a spreadsheet. The big secret here is that the entire break-even analysis completely hinges on one giant, unknowable variable, your life expectancy. You see, the Social Security Administration basically assumes an average life expectancy of 84 years old for someone who has already successfully made it to age 62. And sure, if you live exactly to 84, then holding out and filing late mathematically wins. But watch just how incredibly fragile this math actually is in the real world. According to our sources, if you simply reduce your life expectancy assumption by just 3 tiny years, dropping it down to 81, suddenly filing at 67 becomes the clear, mathematically better play. Drop it by 6 years down to 78, and filing as early as possible at 62 versus waiting to 67 results in almost exactly the same total payout. The optimal textbook strategy completely flips entirely upside down based on tiny, unpredictable shifts in how long you actually live. So, the absolute crucial point you need to understand is that this is a highly personal, deeply human decision. It is not just a cold mathematical optimization problem. Our sources detail some incredibly valid, totally non-mathematical reasons why opening that faucet early at 62 is often the smartest real-world move you can make. First up, we have to talk about the go-go years. Your retirement spending typically peaks early, right when you are still healthy, active, and eager to travel. The money you have at age 63 is fundamentally not the same as the money you have at age 79 because your physical capability to actually go out and enjoy it is completely different. Second, there's spousal coordination. If you have a spouse who has a much lower lifetime earning history, they actually cannot access their up to 50% spousal benefit until you officially file. So stubbornly delaying your claim might actually mean you're relieving years of vital household income sitting on the table. Third, there's the terminal illness double dip strategy. It's grim, but if the higher earning spouse has a short life expectancy, the lower earner can file early at 62, collect their own smaller benefit while their spouse is still alive, and then automatically step up and switch to the much larger survivor benefit later on. And finally, consider real-world market conditions. Imagine you retire at 62 and the stock market immediately tanks by 30%. Turning on your Social Security early acts as a massive safety net, completely preventing you from being forced to sell off your decimated investment portfolio at rock-bottom prices just to buy groceries. Section 4, Defining True Financial Independence. Okay, so whether you're out there managing index funds, fixing up real estate, or trying to perfectly time your Social Security, we really have to redefine what having wealth actually means. We desperately need to take a step back from this idea of pure mindless accumulation. Remember earlier when we talked about crossing that $20,000 threshold and suddenly seeing the world differently? Well, this is exactly what that looks like in practice. Once you truly internalize the math of compounding, buying a $30,000 new car is suddenly no longer just a $30,000 expense. Our sources heavily stress this concept of opportunity cost. The literal second you drive that brand new car off the dealer's lot, it instantly loses 20% of its value. You are actively, voluntarily destroying your own wealth. But honestly, the bigger tragedy is this. If you had instead invested that $30,000 into a boring, diversified portfolio, over the next 20 years, it could have easily grown to over $200,000. So sure, that hefty car payment might make you feel rich and successful today, but you have to realize it is actively, aggressively keeping you away from true financial freedom in your future. So what exactly is the real mathematical threshold for total freedom? Our sources constantly reference Mr. Money Mustache's incredibly famous 4% rule, also known as the safe withdrawal rate. This right here is the magic formula, the exact mathematical tipping point where your investments can literally sustain you indefinitely. It works like this. If you can comfortably live on withdrawing just 4% of your total investment portfolio per year, you are mathematically, functionally independent. You don't have to work anymore. Why? Because the other 96% of your money stays invested in the market, constantly working and compounding in the background to outpace inflation and magically replenish whatever you just withdrew. This, right here, is the ultimate finish line of the accumulation phase. But listen, the numbers on a spreadsheet only actually matter because of what they purchase for you out in the real world. And our sources heavily emphasize a beautiful concept called optionality. Look around. Conventional society constantly measures wealth by flashy, visible markers, right? It's the size of the house. It's the luxury badge on the front of the car. It's the designer clothes. But true, quiet financial independence measures wealth entirely by the options and the absolute freedom your money buys you. Can you abruptly leave a toxic job that is actively ruining your mental health? Can you easily take 6 months off to handle a sudden family emergency without stressing? Can you relocate across the country for love without panicking about making next month's rent? Think about it. A person earning $200,000 a year who spends $195,000 of it has absolutely zero optionality. They are trapped. But a person earning $80,000 who only spends $45,000, that person has extraordinary, life-altering optionality. This all perfectly brings us to a really crucial quote directly from our source material. Let's look at this because it builds perfectly on everything we've just talked about. Quote, "Defining enough creates a finish line. Without it, you're running an endless race where lifestyle expansion always outpaces income growth." This right here is the beating heart, the core philosophy of financial minimalism. You have to consciously decide what kind of home is actually sufficient for you, what kind of transportation truly meets your needs. Because if you don't aggressively define your own personal enough, you will fall right back into the trap, becoming a victim to Parkinson's law. You'll make $150,000 and your brain will immediately redefine your enough upward. You'll spend all of it and you'll remain exactly as trapped as you were on day one. So as we wrap things up, I want to leave you today with this single, incredibly provocative question. What is your exact enough number? Seriously, I want you to think about it. Figure out what exact level of material comfort constitutes genuine, lasting satisfaction for you. Because once you finally define that personal finish line, every single dollar you earn above it can flow directly into buying your freedom, buying your optionality, and most importantly, buying your time. It is time to stop moving the goalpost on yourself, let compounding do the heavy lifting, and start engineering the exact life you actually want to live. Thank you so much for joining us for this explainer today. It's been awesome, and we will definitely catch you next time.
Thanks for watching. If this gave you a new way to think about your wealth, subscribe to Langford Invests. Leave a comment below with the one savings move you're making this year, and I'll see you in the next one.